Sometimes smaller businesses can yield bigger returns in the stock market. That's been the case recently with small cap stocks. In this video, we'll explain what makes a stock a small cap and why those stocks have enjoyed a nice run recently. But first, our sponsor for this video is GlobalX, which offers more than 130 exchange-traded funds in Canada, including 2 that are tied to the US small cap sector. RSSX, the lowest cost Russell 2000 ETF in Canada, and RSCC, the only covered call Russell 2000 ETF in Canada. Okay, let's start by explaining what makes a stock a small cap. I know we talk a lot about indexes like the S&P 500 or the NASDAQ 100, but for small caps, the benchmark is the Russell 2000. It tracks the performance of roughly 2,000 of the smallest publicly traded companies in the US. Now, when I say the smallest, the average market cap for a company in the Russell 2000 is roughly $3.5 billion. Compare that to the NASDAQ 100, where the average market cap is roughly $46.5 billion. But as I mentioned earlier, just because they're smaller in size doesn't mean they can't put up bigger stock market returns. And since the presidential election in early November, the Russell 2000 has outpaced both the S&P 500 and the NASDAQ 100, putting the index back at levels we haven't seen in 3 years. Why? Well, a lot of experts cite the so-called Trump bump. Now, you might recall we saw a similar trend with the Russell 2000 after Donald Trump's first presidential win back in 2016. The president-elect's America First focus is seen as benefiting companies that have a bigger percentage of their operations in the United States. And there are other considerations. For example, the US dollar has been strengthening against a number of global currencies. That can work against some big cap American companies that operate overseas. Think of Apple, for example, which is selling iPhones and other products in markets around the world. And when the currencies in those markets are impacted by a stronger dollar, that can impact Apple's performance. Finally, another consideration with small cap stocks is that they tend to outperform during bull markets, and we're in one right now. And generally, that makes sense. During a bull market, investors are typically willing to take on more risk, and a flood of money into a lesser-owned group like small caps can lead to outsized returns. The flip side is that with generally weaker balance sheets and a less diverse investor base compared to the biggest companies, small caps tend to be volatile and they can underperform during bear markets. What's your view on small caps? Let us know in the comments, and make sure to subscribe for our next investing video.